National Tax Lunch. We do this on the last Friday of the month, every month at noon Pacific time. So I know in the near future, we're going to switch over from daylight to real time. So we'll watch for that, but it's always noon, whatever time zone they happen to be telling us. You can listen in online through CalCPA, just like you're doing right now, or we throw it up on YouTube later and you can watch it that way. This month's topic is indirect and constructive ownership rules for Form 5471. So one of the big messy things is trying to figure out, do I even have a filing requirement or not? Am I the kind of person that triggers the filing requirement for the exceedingly awful Form 5471, and you'd rather not if you can, but the indirect and constructive ownership rules sometimes make you accidentally into what's called a U.S. shareholder, and you have a potential filing requirement. So anyway, we're going to talk just about the indirect and constructive ownership rules today. The speaker is moi, and you can go to hodgen.com for more about us and all that fun stuff. If you have a question during the presentation, throw it in the chat. I'm not going to be answering questions during this hour, but we will collect them and get answers back to you to the best of our abilities. So throw them in there and we'll write a blog post or answer you by email or something like that. And you'll see my email address at the end on the final slide, so you can ping me directly if you feel like it too. So let's get started with the indirect and constructive ownership rules. Introduction. All right, so this is kind of the topic of what we're going to be doing today. It's specifically about the attribution rules that cause a U.S. person, you, or any kind of U.S. taxpayer, to pretend own stock in a foreign corporation. And there are, at this point, 9 different filing categories for Form 5471. We'll be talking about that today. And really, we're just looking at the ownership question. There are many, many other things that factor into Form 5471, but it's just the attribution rules here. A quick comment about words. I am included in this. I'm kind of hand wavy about the way I describe stock ownership, but this is the way that I understand how the code correctly uses the terms in terms of figuring out, are you an owner of stock? And if so, what kind of owner are you? So direct ownership is your name is on the stock certificate, and that's easy. Indirect ownership is where your name is not on the stock certificate of the corporation in question. Instead, there's another entity of some kind, and you have ownership directly in that entity. So the classic situation is a parent-subsidiary relationship. You own all of the stock in the parent corporation. The parent corporation owns all of the stock of the subsidiary. That's a situation where we would say that you have an indirect ownership interest in the subsidiary. Constructive ownership is where you don't have that connect the dots kind of ownership, the ankle bone connected to the shin bone connected to the knee bone, that kind of thing. Instead, you've got some other standalone thing out there that owns the stock, but because of the magic of the Internal Revenue Code, and specifically and mostly Section 318, we pretend that you actually own that stock. So classic situation, husband and wife owns all of the stock of a corporation. Husband, we pretend, is also the owner of that stock. So that's constructive ownership. And then finally, this word attribution. And this is where the hand wavy stuff comes in. We use attribution kind of just to describe anything that's not direct ownership. So attribution rules mean we're pretending that you own stock indirectly, or attribution could mean that we are pretending that you own stock constructively. So attribution is kind of a global signifier. So this is the genus, attribution, species are indirect and constructive. So that's, and you'll read the regs in the code, and sometimes it's not quite as clear as it should be. And sometimes they use the wrong words. But anyway, that's what we're talking about. So when we're talking about attribution, we're really talking about indirect ownership and constructive ownership. Now, where to find the magic in the code? So you see, we have three sets of rules, basically. Categories 1 and 5 go together. They use the same rules. And the key rules are in section 958. A for direct and indirect ownership, and B for constructive ownership. In section 958, it says we're going to use the section 318 constructive ownership rules at section 318A, and it adds some modifications. You're also going to look at the regulations under both of those code sections because there's more fun stuff there. Categories 2 and 3 go together, and there the constructive ownership rules come out of section 6046, little c in parentheses, and the companion regulations that are issued under section 6046. So that's where you're going to go to try and figure out how much stock does your client own and what does that mean for Form 5471 purposes. And then finally, category 4 is all on its own. And there you're going to be looking at section 6038E, like elephant in parentheses, which again incorporates section 318A to figure out who owns what. And there are regulations there. But cunningly, the modifications that are introduced to section 318A by section 6038E are not the same modifications that are used in section 958 for categories 1 and 5, because why would you? So that's where you're going to be. And I encourage you, if you have a problem like this, always have the code and the regs in front of you, because you're going to have to draw little pictures and you're going to have to think and you're going to have to read. Otherwise, you're likely to come to a wrong conclusion. So let's start categories all the way from category 1 to 5, and let's talk about these different rules. So category 1, again, we're looking at sections 318A, which are incorporated by reference at section 958. This is going to be easy for us to hand wave away in this presentation because category 1 and category 5 use the same analytical rules to figure out if there's indirect ownership or there's constructive ownership. Remember that category 1 in the good old days, the Form 5471 had 5 filing categories, but category 1 had been dormant for many years. So we really only had to worry about 4 filing categories. Now they resurrected category 1 for section 965, which was introduced at the end of 2017. And this is for specified foreign corporations, when they have controlled foreign corporations and you're washing out undistributed earnings and profits and getting it taxed because deferred taxation is evil. So anyway, I'm going to talk about all of category 1 later when we look at category 5. Now let's look at categories 2 and 3. So let me back up a bit just so you can put it in context. Categories 1, 4, and 5 look at your status as a taxpayer, as a shareholder at a given point in time, and they say, how much stock did you own at that moment? So it's a status kind of question. How much stock did you own? Categories 2 and 3 are triggered by transactions. Did you have an acquisition of stock or did you have a disposition of stock in the tax year? So it's a little bit different, and you'll see, it's easy to gripe about why do you have different rules for indirect and constructive ownership, but the answer is it's for different purposes, so legit. And this slide kind of puts everything into context. If you're sitting down and you're trying to figure out whether a particular person has a category 2 or a category 3 filing requirement, this is what you have to be thinking about all the way through to figure out just the binary answer to the question, do I check the box for category 2? Do I check the box for category 3? Do I check the box for both? And you start with, is this even a foreign corporation? Because something that says LLC on the back end on a foreign entity may well be a corporation for tax purposes. So you don't ever just rely on those magic little letters at the end of the name of the entity. And then the second and third bullet points, category 2, a reporting person is someone who's an officer director of that foreign corporation, while category 3 is the shareholder himself, herself, itself, for purposes of the 5471. So you're figuring out, number one, what kind of beast do I have? Well, it's a foreign corporation. And then you say, what kind of taxpayer is sitting in front of me? Is officer, director, a shareholder, or both? And that will tell me whether I have to care about one or both of these tax categories. And then you have to understand the acquisition thresholds for, every time you buy more stock or you acquire more stock in some fashion. When do you go over the trigger, which triggers a reporting requirement? And for categories 2 and 3, just so you know, the magic number is at 10%, but as usual, 10% doesn't mean what you think it means all the time. So you have to be careful in reading the code and the regulations and the instructions to the form to figure out whether you've got one of those. I mean, for instance, what happens if the corporation redeems some stock and you were at 8% and now you're at 12% after the redemption of some shareholders' stock? Is that a triggering requirement? Did I suddenly acquire and get over the 10% threshold? Those are the kind of weird things that you've got to figure out. And then in the magic bold, we're talking about how do you actually acquire or dispose of shares? So it's super simple. If I made a capital contribution to the corporation and they gave me some stock, that's easy. But we're talking about indirect constructive ownership and acquisition in those fashions. And then finally, there are plenty of waiver requirements where you say, well, even though technically I'm a category 2 filer or a category 3 filer, I don't actually have to file Form 5471, or there's some sort of abbreviated mechanism that you can file a Form 5471, but it's not like the full burdensome thing that you have to prepare. So here's the deal. What we're talking about. We're talking about specifically indirect ownership. So how do you acquire indirect ownership in a foreign corporation such that you trigger a filing requirement? And constructive ownership. How do you constructively acquire or dispose of stock in a foreign corporation? And therefore, for categories 2 and 3 purposes, you have to check the box and you have to attach all the schedules and report whatever you've got to report. And again, just to remind you, U.S. persons who are officers and directors, interestingly, there's really no guidance about who's an officer or director. So if you have someone who's a vice undersecretary, are you an officer? Well, I don't know. Usually I over-include here, or I make sure that the U.S. persons strenuously avoid any kind of title in the company, anything above janitor. So but anyway, so that's who you're doing. And category 3 is the shareholder himself, herself, itself. And notice that category 2 is just for acquisitions, while category 3 is for acquisitions or dispositions. All right, onward. Let's talk about first attribution from humans. So here's the magic section of the regs quoted here, and it lists all of the people for whom you are treated as if you constructively own their stock. And the important point on this slide is what I put in bold here, is that resident or non-resident status does not matter. If you are the right kind of family member and another right kind of family member owns stock, hey, presto, there's constructive ownership. And here's a little diagram that shows what's going on. So in general, in these slides, you're going to see that if I have a little blue person, that's who we're trying to figure out, well, how much stock does that person own? And as you can see here, the lineal attribution from ancestors to descendants. Is it kind of interesting here that they use ancestors and descendants, where in the other attribution rules, you'll see it says grandparents and grandchildren and stuff like that. So, are you going to have great, 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 great? I don't think so, because they're probably not alive. But anyway, minor little detail. So this is it. I would say that if you're trying to figure out a constructive ownership situation, it wouldn't be a bad idea for you to whip out your legal pad and draw a little diagram like this and put your taxpayer square in the middle, and use that along with whatever kind of org chart you've developed to quickly figure out what the attribution is to the person in the middle, in the crosshairs, to figure out whether they've got a category 2 or category 3 filing requirement. But this is it. This is pretty simple. Good thing, there's no reattribution from one family member to another. So if I get stock attributed to me, I don't then pass that attributed stock downstream to my kids. Here's an example on slide 16 of how this works. So imagine a foreign corporation, and it has two brothers, father and uncle, who are 25% shareholders, and someone unrelated owns the other 50%. And father has a child, and you are trying to figure out, do I have a category 2, category 3 filing requirement? And here's how it works. So at the top, you see the green arrow that points left and it says 25% father to child. Well, we know that directly owned stock is attributed from a parent to the child. So yes, the child is going to be deemed to be the constructive ownership of dad's 25% direct ownership of the 25% of the stock. Now, let's look at dad. We're not doing Form 5471 for dad, but let's pretend that we are. First things first, remember that there is sibling attribution. So father's brother, namely uncle, is going to have his shares attributed to father. So father, at the end of the day, has a deemed 50% ownership position in this foreign corporation, 25% directly owned and 25% constructively owned. But let's look on to the knock-on effect of that constructively owned stock. Remember that father received constructive ownership of the stock from his brother, uncle, but there is no onward reattribution of that block of stock to child. And that's from the regulation that I showed you on the previous slide. So at the end, child has 25% stock. And therefore, if this was an acquisition in the current year, child would have a category 3 filing requirement. I mean, again, I'm not going to get into the niceties of the details, but the child went from a 0% ownership position to a 25% ownership position, and therefore has a category 3 filing requirement. I'm assuming the child is not an officer or director, so we don't have to worry about whether child has a category 2 filing requirement as well. And here's an example of one that I've seen, let's just say, more than once. And in fact, this morning I received an email from a CPA I know asking exactly this kind of position. So this is, let's say you have a US person married to a non-resident alien. The non-resident alien spouse forms a new foreign corporation. Because the US person listens to you, the US person chooses not to be an officer or director of this corporation, and the US person says, I don't want direct ownership of any stock at all. Nevertheless, the US person, in the year that the non-resident alien spouse formed this corporation, has a category 3 filing requirement. And you just look at it like this. You say, well, before there was no corporation, and after we had the spouse who acquired 100% of the stock of this foreign corporation by forming the company and making a capital contribution. And therefore, if the spouse acquired, for reals, the stock of the foreign corporation, then you the U.S. person who's married to the shareholder also quotes acquired, close quotes, constructively the stock. So you have a category 3 filing requirement in the year of formation. This also happens, incidentally, where the non-resident alien spouse owns stock in a foreign corporation pre-marriage, and then you, the U.S. person, married to that person. Hey, presto, you went from a position of having no stock to having 100% constructive ownership of whatever that stock the non-resident alien spouse had, even though the acquisition predated marriage. The acquisition by the spouse predated the marriage, but your acquisition of constructive ownership happened in the current year, namely the year of marriage. So you have to watch out for little weird things like that. My experience is that when we file remedial 5471s like this and we attach a please don't impose a penalty, as often as not, everything goes fine and the paperwork just disappears into the Borg and we never hear from the government again, because it's really a no harm, no foul. And after that, we're not going to have a filing requirement at all for Form 5471. So do not despair. Clean up your messes. Right, let's move on to categories 2 and 3. Again, attribution from entities to owners. So this is what we all call upward attribution. So corporation owns stock, and we treat the shareholder of corporation as owning the stock that the corporation owns. Category 2 and 3 are fairly straightforward. It's a strictly proportional rule for foreign corporations and foreign partnerships. If you've got one of these tiered entity situations, it's just your proportional share of whatever stock is at the bottom of this structure. Little pictures here just to demonstrate that, number one, how it works, and number two, the fact that whether you are a shareholder in a foreign corporation or you are a partner in a foreign partnership, the same thing works both ways, proportional ownership downstream. So in this case, the blue person is the person you're doing the tax return for, and you're trying to figure out, is there an acquisition of stock? And the answer is the blue person has 40% of the parent corporation on the left. The parent corporation owns 80% of the subsidiary, 4/8 of 32, 32% deemed ownership of the subsidiary stock. So if you went from foreign corporation 1, which is the parent, formed the subsidiary in the current tax year, well, the blue person acquired 32% of the stock and therefore has a category 3 filing requirement. Same thing on the partnership side. We're not going to talk about attribution for partnership purposes, but there you are. Other entities. So I don't like to just take silence as golden in the code. I want to know why silence is safe. So the section 6046 does not talk about foreign non-grantor trusts. It does not talk about foreign estates. So it's silent. And what do we do? I mean, the logical inference is we just say there's no constructive ownership because the code is silent and the regs are silent. But in fact, it kind of makes sense. You remember we said before that there's no reattribution of stock from a human to another human. So if we took in the previous example, instead of a blue human at the top, we had a foreign non-grantor trust at the top, I think the result would be the same, because foreign non-grantor trusts, for instance, are treated as non-resident alien humans that never set foot in the United States. And so if we attributed the subsidiary stock to the foreign non-grantor trust, it would be logical and consistent within section 6046 that we would not then reattribute from the foreign non-grantor trust to its beneficiaries. So I'm comfortable with the idea that we do not attribute stock further for category 2 and category 3 purposes from a foreign non-grantor trust. And we could go through the same logic for foreign estates, but I think it works that way. For US corporations and partnerships, that's another set of entities. Again, the code and the regs are silent, and I believe that this means that you don't have to worry about constructive ownership calculations for categories 2 and 3. And this also makes sense because they're domestic entities, they're US persons, and they have their own potential Form 5471 filing requirements. So again, the silence makes sense in the bigger picture. And then finally, we have pass-through entities like grantor trusts and disregarded entities. And again, there's silence. So how do we figure out what does silence mean? Is silence safe or is silence dangerous? And I think silence means that it's really deemed direct ownership. So for instance, grantor trusts, whether foreign or domestic, the revenue ruling says basically that when you have a grantor trust, the grantor is the actual owner of the trust assets. And so if we just sort of extend that idea, if we have a human grantor and a grantor trust, revocable trust, for instance, and the revocable trust owns the stock of the foreign corporation, I would treat the grantor as the direct shareholder of the foreign corporation stock that's owned by that grantor trust. Similarly, with disregarded entities, this Suzanne Pierre versus Commissioner was a pretty fun case. I don't know, at a decade, 2009, so more than a decade ago by now, where a woman put $10 million of cash into a single member LLC, gave away bits and pieces of the LLC to her kids, and successfully got a valuation discount on the gift. And this is a fun situation where the disregarded entity rules say, well, if you make the election or if it's a disregarded entity that's disregarded for all tax purposes, but the tax court said, oh, no, it isn't. It's not disregarded for some tax purposes. But, that aside, I think for income tax purposes, it is appropriate here, and this is the way I would do it, to treat the single owner of a disregarded entity as the direct owner of the foreign corporation stock that's owned by that disregarded entity. So that's how I would do it. Categories 2 and 3, now we've got the fun downward attribution. And there's been a lot of noise about downward attribution and wringing of hands and weeping because of what our friends in Congress did in 2017. But for categories 2 and 3, yay, Section 6046 never had any downward attribution rules, and it was not introduced in 2017, so we don't have that problem here for purposes of categories 2 and 3. So there we go. We've wrapped up human-to-human constructive ownership. We've talked about indirect ownership through structures, upwards and downwards, and we're ready to move on to category 4. Category 4 is for U.S. persons who control a foreign corporation. And you can see here that we're looking at the operative provision is Section 6038, which incorporates Section 318A, the default constructive ownership rules. And it also is Section 6038A also has some mods, to say Section 318A, change this to that. Here's the detail. This not that bad when you look at it. So you start with the basic rule in Section 6038E2. Then it says, rope in Section 318A rules. And then you look at Section 318A for the basic constructive ownership rules, but you modify them in 2 instances. It's number 1, to prevent downward attribution from foreign persons. So now we're seeing downward attribution for the first time, but it's not 100% downward attribution. It's only in the context of downward attribution from a U.S. person to another U.S. person. We don't care about downward attribution from a U.S. person to foreign person because you're not preparing a Form 5471 for a foreign person. And the second one is the modification of the Section 318A rules for constructive ownership from foreign corporations, where there's different levels of thresholds where either you're going to do constructive ownership or you're not, and this just modifies those thresholds. Who is a category filer? A category 4 filer? It's a U.S. shareholder who all by himself, herself, itself has more than 50% ownership of the stock of a foreign corporation. And Contrast that with a controlled foreign corporation, which can have multiple U.S. shareholders. So you can have, three people who each own 1/3 of the stock, and you have a controlled foreign corporation. But unless these people are related in some fashion, none of those three people will be a Category 4 filer. And control means more than 50% by voter value. So, no fun and games there. It's, you play it pretty straightforward. Let's go through the same sequence again: family attribution, upward down attribution, then downward attribution. A little bit different this time, isn't it? So here our little X marks the spot diagram. Note that we've got grandparent and grandchild instead of ancestors and descendants. And we're not counting the grandparent, but we are counting the grandchild. And we're not counting siblings this time. Again, we are allowing attribution, constructive ownership, from non-resident aliens. So when you're preparing or considering, does this person, the person at X marks the spot in blue, does that person have more than 50% ownership? These are the people from whom you are going to figure out whether there's stock ownership, constructive ownership. There's no reattribution among family members. So here I have an example where grandfather owns 100% of the stock of a foreign corporation. Father, for whom we are not looking at Form 5471, is treated under the parent-child attribution rule at Section 318 as owning 100% of the stock of the foreign corporation from his dad, namely grandfather. But the attribution does not flow downstream to child, and that's the person that you are preparing Form 5471 for, or trying to figure out whether you even have to. And there's no knock-on reattribution of stock from father to child of the grandfather's stock. So, and note here, no reattribution. Why? And there's reference to Section 318A5. One of the reasons I'm saying keep the code and the regs in front of you is because there are little weird rules here and there that say, yeah, but, and the reattribution rules are part of the yeah, buts. And there are other situations where there's a kind of a no double counting rule where you can attribute in different directions. They have special rules who don't attribute them all, the same block of stock in multiple directions, only attribute it to one person. So that's why I'm saying move slowly and have the law in front of you. So here's an example of one of the, hey, we can attribute stock in multiple directions all at once. So we have father who owns 100% of the stock of foreign corporation directly. Spousal attribution says mom should have 100%. Parent-child attribution says child should have 100%. And so potentially we have three controlling foreign corporations, and you say it wrong, and it sounds like we got 300% stock ownership of this single foreign corporation, which sounds wrong. It shouldn't be more than 100%. But really what you're measuring is not stock ownership. You're measuring control, and child has, quotes, control because of the attribution rules, and mom has control because of the attribution rules. And so here is the no double counting or attribute it all only in one direction exception in the regs under Section 318 for a situation like that. And the key in this thing is, I'm going to read it just, and then I'm going to stop with the key phrase, what you have to keep in mind. In applying Section 318A to determine the stock ownership of any person, so child or mother, for any one purpose, and that's the key, for any one purpose. And then it goes on to say, then the stock owned by someone is only going to be included once in one attribution in one direction or the other. And you impute ownership to make the single biggest shareholder you can. And so let's talk about that for one purpose. And so look at it this way. You're sitting there with child's tax return on your desk, and you're trying to figure out, is child a category 4 filer for Form 5471 purposes? So that's your purpose. And you say, for child's filing requirement, is child deemed to be is child deemed to own the father's stock? Answer is yes. And then for the purpose of mom, we ask the same question. And again, we have to say yes. So we are attributing the stock of father in two different directions, but for two different purposes, to determine two different shareholders' filing requirements. So you look at that exception in Section 318 regs and you say, this saves me. But the answer is not necessarily. So the way I look at this is that dad is a category 4 filer because he owns 100% of the stock directly. Child and mother are also category 4 filers because they constructively own 100% of the stock, and therefore they have control of foreign corporation. And the solution to the problem is not in the attribution rules and parsing the meaning of some code section or a regulation. The solution actually happens in the instructions to Form 5471, where there are different ways to handle problems exactly like this, where you have multiple people who are deemed to have filing requirements. What do you do in that situation? And so you can see here, I've given you a reference to the page numbers in the instructions to the Form 5471, the latest edition. But let's look at it. Multiple filers of the same information. One person can file Form 5471 for everybody who has the same filing requirement. Another way, and this is one that would apply in the example I just gave you, where someone is a constructive owner of stock but has no direct ownership of stock. And so if you have that kind of situation, so dad is a US person and he files Form 5471, mom and child are technically category 4 filers, then this exception says that the constructive owners, namely mom and child, need not file Form 5471. So this is one of the Lord giveth, the Lord taketh away kind of situations. But it's really important to go through the whole analysis logically and say, yes, I have a category 4 filing requirement, but yay, I've got a trapdoor and I can sneak out the back way and escape the Form 5471 preparation problem. And then you have a constructive owner, with no direct or indirect ownership. And this is for attribution from a non-resident alien. And again, if you have this situation, then the constructive owner need not file Form 5471. So in this case, if dad were a non-resident alien and mother and child are US persons, then the attribution for category 4, you would not have to file a Form 5471 for the mother or child. So that's how it works. Category 4, let's talk about attribution from entities to owners. So remember, we're talking about attribution, but we're really talking about indirect ownership if we want to get sort of anal retentive about the whole nomenclature. And there's nothing wrong with being a little bit anal retentive from time to time, as a tool, not as a way of life. So, okay, let's go through it. Partnerships, estates, non-grantor trusts, grantor trusts. Easy peasy. It's just a basic proportional share rule where you go through and do the math and you own your proportional share of the lower tier foreign corporation that's owned by a partnership, an estate, a non-grantor trust, or a grantor trust. Note in the grantor trust situation, you just look at the grantor trust rules and you say, who is the owner? And that's the person who is treated as the shareholder, therefore has control, therefore, category 4 filer. Indirect ownership through corporate structures is a little bit more complex. You have a floor. So if again, let's just conjure up in your head the parent subsidiary situation. You are a shareholder in the parent, and this parent corporation owns a subsidiary. So the left column in my little table here is what's your stock ownership percentage in the parent? The middle column is when the parent owns up to 50%, up to and including 50% of the subsidiary stock. And then the right column is when the parent owns more than 50% of the subsidiary stock. Looking at the first row, the row that says less than 10%. So if your ownership in the parent is less than 10%, there's no attribution. You're done. So that's the floor. That's kind of the filter below which they don't care. So even if the parent owns 100% of the subsidiary, if you are a less than 10% owner of parent, you don't have a category 4 filing problem at all. You don't have to go through the attribution rules, and you're safe. For the middle row, so that's 10% or more, and in theory, it could go from 10% up to 100%, but in reality, the bottom line says it only matters from 10% to 50%. It's just the straight kind of pro rata computation that you've always done. You know, I own 25% of parent company. Parent company owns 100% of subsidiary. Therefore, I'm an indirect owner of 25% of subsidiary stock. That kind of easy peasy kind of calculation. The more than 50% situation. So when you own more than 50% of parent and the parent owns more than 50% of subsidiary, you are treated as having automatic control of subsidiary, and you're a category 4 filer for the subsidiary. So note what's happening here. You have more than 50% ownership of the parent company. Therefore, you have control automatically of parent. And now we're looking downstream and we say, well, parent owns more than 50% of subsidiary, and that same automatic toggle for control exists happens for subsidiary for you. If the parent owns up to 50% of subsidiary, but not more than, so up to and including, then it's just going to be the same old pro rata rule that you're working with previously. And here's the magic phrase and the words out of the good book of the regulations. I wonder if the apocalypse comes in the regulations just like it does with Revelation. But I digress. So here's just a little quickie example. So let's walk through the logic. It's kind of like, you know, the transitive principles in mathematics. So number one, we have you as the red person. I didn't switch this over to blue, so forgive me. You have more than 50% of CFC1. Therefore, you have automatic control of CFC1. CFC1 owns 60% of CFC2. Because CFC2 owns more than 50% of CFC2, therefore, you have control of CFC2. So that's how it works. Downward attribution. For downward attribution, we have the same kind of thing where we've got the proportional rules or not, right? So look at this, where we were looking at upward attribution from entity to human, for instance, in the examples we've been talking about, where it was a pro rata rule. Look at what we've got going on now, where if you have a partner, the partnership is treated as owning all of the stock of the partners. So it's an all-in kind of thing. Same thing with estates. Same thing with non-grantor trusts, with the exception of a little 5% actuarial value kind of beneficiary, so minor beneficiaries we don't care about. And grantor trusts are treated as if they own all the stock owned by their grantors. So that's going to be the downward attribution for these kinds of entities. Corporations have a 50% threshold. So if you are at or above the threshold, you have downward attribution. So in the example on the left-hand side, you, the red person, own stock of B Corporation of any quantity, and you own 50% or more of Corporation A. That means that Corporation A, we're going to pretend, owns Corporation B stock. The example on the right is your ownership of Corporation A is less than 50%. Therefore, Corporation A will not be treated as owning any of your Corporation B stock. So important for downward attribution, we had a lot of kerfluffle at the end of 2017 with the repeal of Section 958B4, which was an anti-downward attribution rule for categories 1 and 5. And that had no impact on category 4 because category 4 always had downward attribution. So nothing happened here at the end of 2017 compared to categories 1 and 5. And so it's an important thing to watch out for, and you're going to be watching out. Again, we're looking for, is there control? So in theory, on this left little picture, if we attribute some stock of Corporation B to Corporation A, who knows? Does Corporation A all of a sudden be deemed to have control over Corporation B? Well, I don't know on there. Important, something that will help you and possibly save a problem. There's no downward attribution from a foreign person. So if in my prior diagram, let me flip back to it, the little red person, you are a non-resident, we're not going to go through this downward attribution to try and figure out whether Corporation A is deemed to own the stock of Corporation B. So if you're a non-resident, no downward attribution. If you are a US person, yes. And also just remember that United States person does not just mean a human being, it means domestic entities as well. All right, now we come to the final part, which is categories 1 and categories 5. So category 5. These are for the transition tax, section 965 compliance, that's the category 1, and then just generic controlled foreign corporations for category 5. The operative rules here are section 958 and 318. On we go to family attribution. Here's what happens. Just notice that the Zoom thing is blocking. I don't know if you can see it or not, but that's the fourth wall. Hey, okay, let's get back to the slide. Family attribution. This is where you just, if you're doing tax, you just have to be super careful every time and make sure that you're plotting and methodical to get things right. And look at the bottom, attribution from a non-resident alien allowed. If you put your brain into autopilot and the difference in attribution calculations between category 5 and category 4 are going to be almost the same, exactly the same, except that we're not going to have attribution of ownership of stock from a non-resident alien family member, whereas we did for category 4. So this is when you figure out filing requirements, you're going to have to figure out, well, who is the shareholder and what are they and where do they live? So watch out for this. The family attribution rules here, again, is no accident that it looks a lot like category 4, and it does. Remember, no attribution from grandparent, no attribution from sibling, but also top right-hand corner, the purple person, no attribution from a non-resident alien. And so this is one of the overrides that section 958B introduces to change the default rules of Section 318A, because the default rules of Section 318A say we don't care what you are, we're going to do family attribution this way, thank you very much. Whereas Section 958 says, no, we're only going to do it for U.S. persons, not for non-resident aliens. Again, you've seen this before. There's no reattribution downstream. So you're looking at the child's tax return in Form 5471 and whether there's a Category 1 or 5 filing requirement, at least in the context of grandfather's stock in foreign corporation. Father has constructive ownership of that stock, but grandchild does not. And so if father is a non-resident alien, then you're also going to be safe, just as an aside for the child. Categories 1 and 5, attribution from entities to their owners. So now we're talking about upward attribution. Again, familiar kind of concept, and it's familiar because we're incorporating Section 318A. It's a proportional rule. You know, everything proportionally flows upstream to the U.S. person when you're trying to figure out indirect ownership. So that's for partnerships, estates, non-grantor trusts, and grantor trusts. For upward attribution from a corporation to a shareholder, there's this 10% threshold below which there's no attribution, and 10% or more, there is pro rata share of attribution of stock upstream. And see here that the default Section 318 threshold is 50% if you look at Section 318, but 958 little b in parentheses, little 3 in parentheses says where it says 50%, stick 10% instead. So that's why it's your actual threshold. So the little picture just shows that, you know, below or above 50%. Now, categories 1 and 5, attribution from owners to entities. So this is the downward attribution situation that became the bane of our existence starting with the end of 2017. So again, you know, refer back to your mind and everything you remember about category 4. It's one of these all or nothing kind of things. Partnerships are treated as owning the stock that partners own. Estates own foreign corporation stock that its beneficiaries own. Non-grantor trusts, same thing, except for actuarially tiny beneficiaries. Grantor trusts, the grantor trust owns everything the grantor owns. Here, for downward attribution, the 50% rule applies because the exception in 958B3 that converted 50% to 10% for purposes of upward attribution didn't apply here. So, yay. Oh, let me get back here. You know what? We're going to have to, let's just look at this one really fast. We want to figure out, I want to draw to your attention, there's no slide here, but you remember the no double counting rule that we talked about in category 4 when we were trying to figure out control? There is a similar no double counting rule for category 1 and category 5. And the no double counting rule, don't attribute the same block of stock to two people at once for the same purpose, is in Reg section 1.958-2F2. Again, 1.958-2F2. Ask me how I know. I've been living in that pain for the last week or so, trying to unravel the mysteries of do we have an accidental CFC because of the newly introduced downward attribution rules. If you have an accidental CFC because of the downward attribution rules, this is the topic of last month's International Tax Lunch, but I'll just revisit it shortly. If you look at category 1 filers and category 5 filers on the form 5471, you'll see that as compared to last year, now we have category 1A, 1B, 1C, and 5A, 5B, 5C. And categories, the little B and C subcategories, are intended to help with your filing burden in situations where accidentally the downward attribution rules magically created a U.S. shareholder, and therefore magically you've got a category 1 or 5 filing requirement, and you've got a burden, especially when, if you've accidentally through downward attribution created a U.S. shareholder who really doesn't have access to data. So how are you going to prepare the Form 5471 and report the information requested? You'll look at those categories, 5B and 5C, 1B, 1C. And if they give you some filing relief and say you don't have to file as many schedules and this is what you do, then you jump on it. So I just want to bring that to your attention because downward attribution has created some practical problems that did not exist before the end of 2017. And there we are. All I'm going to tell you here is, as Paul Harrell says, kids don't try this at home. I'm what you call a professional. And there are a lot of rules and there are a lot of exceptions. The 1.958-2F2 exception is one that I tripped over and broke my nose when falling on the concrete because I decided that there was a problem here without looking at the regs, like I keep telling you to do. And I hurt myself in front of the client and had to revisit it and say, no, actually, you're going to be safe. So I'll just learn from my pain. I mean, and this is within the last week that I did this to myself. So read carefully. And you know what? I kind of knew this thing existed in the back of my head, but I completely forgot in the burden of the moment. So the other thing I want to tell you is that third bullet point. You would think that all the way through the constructive ownership rules and the indirect ownership rules, the template is going to be you own X% by vote or value. But it's not true. There are some situations where it's just by value, or by vote. So you have to read the regulations carefully on the off chance that you have a situation where you have non-voting stock, for instance, or you have preferred stock that has a ridiculously overweight percentage of the valuation of the company as compared to voting power or something like that. And then the last thing I want to say is, and you know all this already, but know the entity ownership structure extremely well. My experience in these kind of situations where you have a lot of non-resident alien ownership, they don't necessarily always want to tell you the full picture because they don't want to rat out on Uncle Fred or other people where they say, well, that person has no contact with the US. Why should they even know? But that hidden person where you sort of have a cloud in your knowledge of the ownership structure may well be somewhere where accidental constructive ownership occurs and creates a real problem. So you kind of got to know it. And with that, I am done. There's my contact information. And I will turn it back to Rob and see you next month when we're going to be talking about holding structures for non-resident aliens buying U.S. real estate. See you next month.